Well, the latest U.S. weekly jobless claims data declined unexpectedly, holding below the average last seen in 2019 when the unemployment rate was at 3.5%, its lowest in 50 years. Let's dig more into this data with Yelena Shulyatyeva. She is from Bloomberg Economics. Yelena, help us understand the connection here between this unexpected slight decline last week and what we're seeing right now play out with the Omicron variant. Is labor just so tight right now that employers are absolutely unwilling to let people go?
Oh, that's definitely true. And also because it's so hard to find new workers as well, not just because Omicron, but just in general, the lack of available workforce. So, but it's very difficult to seasonally adjust the data during the holiday weeks. So I wouldn't take too much signal from just one data point. Nonetheless, the trajectory is definitely to the downside, and we are seeing readings like that. We saw the readings before below 200,000 a couple of times already. So that actually means that we will continue to see this tight labor market going into 2022. The number I look at in this report, in jobless claims report, is also something called insured unemployment rate. This is the number of people getting unemployment benefits as a percentage of labor force, and that number dropped to 1.3%, the lowest in this cycle. It is only just 1/10 above 1.2% that we observed right before the pandemic hit. So that means we will see significant progress in U3 in official unemployment rate going forward.
Help me reconcile what we're seeing in this data, the positive trend in this data, and all the anecdotal evidence we have of companies saying they just can't hire enough people. You see, particularly on the lower end of the wage spectrum, so many stores and restaurants basically saying they have positions open for everyone. Anyone who basically wants one, they have one. Are there just people who have completely dropped out of the labor force? They're just not coming back?
That is true. Also, that educational attainment plays a large role. So people get more educated, more and more people have higher education. So that means less people for blue-collar jobs, also less immigration. That reduces the pool of available workers as well, so at a lower income spectrum. So I think that we will see the same trend going into 2022 when workers at a lower income spectrum, they will have an upper hand in terms of wages and wage growth. So that will support wage growth going into the next year.
Yelena, talk to us a little bit about the gig economy. With this kind of post-pandemic return to work, a lot of people are looking for those flexible options. How does that play into all of this?
So yes, absolutely. But you also see income coming from these people as well. So like if you look at a broader measures of economic variables such as personal income and salaries, you see that growth in income exceeded anything we have seen since 1984. Yes, we are talking about inflation being the highest since 1982, but you have to remember that average growth in personal income is also quite strong. So that also means we will see significant increases in consumer spending, particularly in the services sector.